Chinese shares continue to gain ground, with investors reacting positively to signs of intervention by state-backed funds. Our next guest says Chinese stocks and bonds look attractive compared to the U.S. this year. Joining us now is David Kutla, founder and CEO of Mainstay Capital Management. David, always great having you with us. There's a belief that perhaps we have seen the floor for Chinese stocks, especially now that we have the so-called national team backing the markets. What do you think?
I think we have. We heard Kathleen talk about earlier in the show what the Asian central banks are doing or not doing right now. And that's one of the keys. The PBOC has been stimulating the economy. They're in easing mode. We believe at least through September, when Xi Jinping comes up for reappointment, wants everything to look good in the country and going well. We contrast that to last year when there was this crackdown on industry after industry. We had the real estate crisis that was led by Evergrande, and now we see that we have a runway ahead of us, we believe, for several months, a year or more, for a market that was down 25% over the last year, that we see a relative price appreciation relative to U.S. shares, which we have a Fed in tightening mode. European shares, we have the ECB is now pivoted to tightening. And so we think that there are a lot of catalysts there for the China stock market.
What about within the Chinese market, say A versus H shares?
We prefer the A versus H shares. One of the ETFs that we like here in the U.S. Is the FXI. It's a VanEck or iShares fund that focuses on large cap China companies. It has done quite well, positive territory this year. And again, that's what we like about the A shares in China right now is they are rebounding over the past month. Expect that to continue.
David, when it comes to the ring fencing of the property issue, that's still kind of a drag when it comes to sentiment, right? Is that something that I expect has been managed by now, or is it something that really will continue to cause concern for investors this year?
Hi, Heidi. Yeah, I think there's three headwinds really for China as we look at it right now. Omicron being probably the most serious issue because of the policy that China takes in dealing with COVID. So we're seeing complete cities of 1 million or more people being locked down. Probably the number one issue currently, but we believe that COVID starts to fade more and more in the past, and all countries find ways to deal with that better. Real estate, I think it's been largely ring fenced. It's still a potential potential headwind for China shares, but we think we're moving past that. That and if we look at overall monetary policy and where we've come from, we think we have again a long runway ahead for China shares.
David, when it comes to the way forward for energy stocks, we've seen quite a bit of outperformance already. Does any kind of pullback or repricing when it comes to crude suggest that we may have seen a peak, or is there further to go?
I think there's further to go. Last year, we were calling for $100 per barrel oil in early 2022. Now, when you go back to late November, early December, when WTI and Brent were trading in the high 60s, that seemed like a pretty lofty goal. And there were some calling for it later this year. But, when we look at the overall environment, we have inventories continuing to tighten. We have demand continuing to increase. And there's these questions about OPEC capacity. They're increasing their targets month by month, but they've shown over the past several months they're not meeting those production targets. So we think that we see $100 per barrel oil early in 2022. It's just a matter of how far above that and how long we stay there. Looking at where we've come from with Brent crude trading at, as high as the mid-90s just last week.
David, always great to have you with us. David Kudla, founder and CEO of Mainstay Capital Management. You can get a roundup of the